Welcome back. Today, we're decoding the June 2026 NSE Market Pulse report. And let me tell you, looking through this data, a massive contradiction emerges. We're talking about a story of two completely different economic realities happening at the exact same time. It's wild. This affects literally everything, from global supply chains right down to the investments sitting in your own portfolio.
Seriously, how on earth is India's domestic market shattering records and seeing this unparalleled growth while the rest of the global economy is frantically pumping the brakes? We're not going to slowly walk through a standard agenda today. We are jumping right into the deep end. It's a high-stakes tug-of-war between international anxieties and this incredible, almost unbelievable domestic momentum.
Okay, let's dive into this dichotomy. The world economy? It's slowing down. It's weighed down by persistent conflict in West Asia and central banks hiking up interest rates just to fight off economic stagnation. Honestly, it's a pretty grim global picture. But then, there's India's domestic reality. The statistics are practically leaping off the page. We're looking at a blistering 7.7% GDP growth, a staggering $4.9 trillion market cap, and over 13 crore investors jumping into the market. The global economy is sweating under immense pressure, while India appears to be throwing a massive financial block party. It's an economic paradox of epic proportions, and to really understand it, we first need to understand the storm clouds gathering outside India's borders.
Section 1. Navigating the persistent risks, the global backdrop.
So here's the reality of the external pressures we're dealing with right now. Major international institutions are definitely ringing the alarm bells. The World Bank projects global growth slowing down to just 2.5% in 2026, and the OECD, they expect a moderation to 2.8%. Now, you might note that crude oil has dipped below $90 a barrel, but make no mistake, conditions are far from normal. Sure, an interim understanding between the US and Iran in West Asia has brought some partial relief to energy supply anxiety, but, well, the executive summary of our report is crystal clear on this. When a conflict persists this long, the economic ripple effects, like disrupted supply chains, they create these stubborn, elevated inflation expectations. That persistent inflation is exactly why major players like the European Central Bank and the Bank of Japan are forced to keep raising rates. They're tightening the monetary policy screws on a global scale just to try and cool things off.
Section 2. The heat is on. Climate shocks and inflation.
And this brilliantly illustrates that moving beyond traditional financial metrics, there's a vicious cycle reshaping India's economic outlook. It starts with rising temperatures, which directly destabilize the monsoons. This erratic monsoon impact leads to lower agricultural output and productivity. That ends up slowing down parts of the economy, and ultimately it traps us in a cycle of really sticky inflation and heavy cost pressures. So when the price of everyday goods feels stubbornly high, you can actually trace a lot of it right back to this exact climate-driven loop.
Section 3. India's surprising macro resilience.
7.7%. Let that sink in. In a world where the World Bank is projecting a sluggish 2.5% for global growth, India's real GDP growth in the new base series has clocked in at an incredibly robust 7.7%. This isn't just a slight overperformance, it's a blazing beacon of economic expansion in an otherwise slowing world. And to protect that growth, India is basically built a fortress. $682 billion. That's the size of India's forex reserves noted in this report. In a volatile global market where currencies are under immense pressure, this massive war chest acts as a vital buffer. It provides the sheer scale necessary to stabilize the rupee, protect against sudden import cost spikes, and frankly, it gives policymakers the breathing room they desperately need to keep the domestic engine running smoothly.
But perhaps the absolute most telling sign of resilience is how India handled the flight of foreign capital. Foreign portfolio investors, totally spooked by all those global uncertainties we just talked about, they pulled a massive $24.1 billion out of the Indian market in 2026. Now, in years past, that kind of capital flight, it would have triggered a total market crash. Yet, domestic institutional investors completely absorbed the shock. They poured in an astonishing $41.4 billion. When the world retreated, domestic money stepped up to the plate in a truly historic way.
Section 4. The Retail Investor Tsunami.
Now, what's really interesting about this slide is $4.9 trillion. That is the total market capitalization of NSE-listed companies as of May 2026. The sheer gravity of this number is honestly difficult to overstate. It reflects immense corporate growth for sure, but it also reveals a tidal wave of new money flowing into the system, fundamentally changing the entire financial landscape.
And whose money is it exactly? Well, it's coming from 13.1 crore unique registered PANs on the NSE. We're not just talking about abstract institutional accounts here. We are talking about actual human beings. 131 million unique individuals participating in the equity markets. This is no longer just a financial statistic. It's a massive cultural shift in how people save, invest, and build wealth for their futures.
And this retail boom, it isn't just isolated to the traditional financial hubs anymore. Unprecedented financial inclusion is literally sweeping across the country. Check this out. Nearly half of all new investor registrations, 46.4% to be exact, are coming from Uttar Pradesh, Maharashtra, West Bengal, Bihar, and Tamil Nadu. The participation is broadening out geographically, really embedding the equity markets into the very fabric of the wider domestic economy.
As we bring this explainer full circle, we have to return to a really crucial insight from the NSE Market Pulse executive summary. Quote, "Partial relief, persistent risks. Once a conflict persists long enough, its effects do not disappear with the first signs of de-escalation." End quote. It's a vital reminder for all of us. Yes, the domestic boom is incredibly loud right now, and the retail participation is absolutely historic. But those global risks, from volatile energy markets to climate-induced inflation, they are quietly, stubbornly lingering in the background.
Which leaves us with the ultimate question, doesn't it? Can this surging domestic enthusiasm actually continue to outpace the heavy, persistent global uncertainty? It's the defining economic balancing act of 2026, and definitely a dynamic we all need to watch closely. Keep questioning the data, stay curious, and keep learning.